You've heard the same story repeated for decades. Whenever the world feels unstable, people assume billionaires are buying gold, Bitcoin, real estate, or blue chip stocks. It is a comforting narrative because it feels predictable. Financial media loves it because it sells. Retail investors love it because it feels like a roadmap to follow. But here is the truth nobody says out loud. By the time the public hears what billionaires are buying, the billionaires have already stopped buying it. When gold reaches $4,000 an ounce, headlines scream that hedge funds are accumulating it. When Bitcoin approaches $100,000, commentators claim the ultra wealthy are diversifying into crypto. When real estate surges, journalists insist that billionaires are snapping up properties everywhere. All of this is technically true, and all of it is also completely late. The assets the media obsesses over are always the assets billionaires accumulated years earlier. What the public sees is the last move, not the next move. Meanwhile, the ultra wealthy have already shifted their focus somewhere else. Quietly, silently, without press releases, without interviews, without leaving any trace for retail investors to follow. They are accumulating three obscure asset classes that most people have never studied or even heard of. These assets are unglamorous, unfashionable, and often ignored by traditional financial education. Yet these are the exact assets that become priceless the moment the financial system fractures. They become essential when supply chains fail, when currencies lose trust, and when the world enters a period of volatility. This video is about those assets, not the familiar ones everyone debates, but the forgotten ones, the quiet ones, the ones billionaires are buying now in the year 2025. Before we reveal all three, we need to begin with the first one. Ironically, it sounds boring, and in the world of wealth preservation, boring is often a signal of something deeply important. The first asset, a new frontier of power. Most people imagine farmland as dusty fields, tractors, and old barns, something tied to tradition, not something connected to billionaires. But the wealthy do not buy farmland because they love agriculture. They buy it because farmland is the oldest form of power humanity has ever known. Empires were built on fertile soil, kingdoms collapsed when their fields failed, harvests determined whether civilizations thrived or starved. Farmland is not merely an investment, it is a survival mechanism. It is a timeless store of essential value. And in 2025, billionaires are not buying random farmland. They are buying extremely specific farmland with extremely specific characteristics. No one has done this more quietly or systematically than Bill Gates. As of 2025, Gates owns approximately 275,000 acres of American farmland. That is larger than the city of Los Angeles. It is roughly the size of Hong Kong. One man now holds more farmland than any other private individual in the United States. He did not buy it impulsively. He did not acquire it by accident. He accumulated it strategically, parcel by parcel, beginning in 2013. What matters most is not how much he owns. What matters is what he chose to buy. Because Gates is not investing in today's agriculture. He is preparing for a future shaped by climate volatility, water scarcity, and soil degradation. Let us break down the pattern. Louisiana, the first clue, Gates' largest farmland concentration is in Louisiana. He owns 69,071 acres across multiple parishes. This land sits in the Mississippi River Delta. This region contains some of the richest topsoil in the entire continent. The soil was formed over thousands of years by river sediment. It cannot be replicated with technology. It cannot be rebuilt once it is lost. The land also has abundant water access from both aquifers and the Mississippi River. This combination will become priceless in an era of droughts and water stress. Louisiana also offers long growing seasons, allowing multiple crop cycles per year. Gates is not betting on corn or soybeans. He is betting on the capacity to produce food when global systems become unstable. The Arkansas and Nebraska strategy. In Arkansas, Gates owns 47,927 acres. This region is ideal for rice and soybeans, supported by steady river-fed irrigation. In Nebraska, the strategy becomes even clearer. He purchased land directly above the Ogallala Aquifer. The Ogallala is one of the most important groundwater sources in the world. Much of the aquifer is being depleted, but the area Gates purchased is where the aquifer is deepest and most stable. This means reliable irrigation for decades, possibly for an entire century. He did not buy farmland. He bought guaranteed water. Washington, Florida, and the final pattern. In Washington state, Gates owns 16,097 acres with direct access to the Columbia River system. In Florida, he owns 14,828 acres with year-round growing conditions. Different states, different climates, different crops, yet the same strategic pattern emerges. Premium soil, reliable water, climate resilience. This is not speculation, this is preparation. Farmland is only the first chapter, because billionaires are not only buying the land that grows food, they are buying something far more powerful. They are buying legal control over the water itself. And that changes everything. Farmland gives billionaires control over food production. But food production depends on something even more fundamental. It depends on water. Land without water is just empty soil. But water without land is still power. That is why the second asset the ultra-wealthy are accumulating in 2025 is not water itself. It is the legal right to use water. These rights are called water rights, and they are one of the least understood, most powerful asset classes in the modern world. Owning water rights is not the same as owning a river. It is more like owning the permission slip that decides who may access that river. And in an age of climate stress, permission is everything. Let us break down how this system works. The law. Most people do not know. In the Western United States, owning land does not give you ownership of the water beneath it. Water rights are legally separate from the land. You can own 1,000 acres of farmland, but you may have zero legal right to use the water below your soil. Instead, water rights follow a rule created in the 1800s. This rule is called prior appropriation. The rule is simple: first in time, first in right. The earliest settlers who claimed water rights in the 19th century hold senior rights. Anyone who claimed rights later holds junior rights. This creates a strict hierarchy. In times of drought, senior rights holders receive their full allocation. Junior holders receive whatever is left. Sometimes that means nothing at all. When you understand this hierarchy, you understand why senior water rights are more valuable than large buildings or high-yield bonds. Water is not optional. It is survival, and billionaires recognized this pattern long before the public did. The Pickens model: water as a city-sized asset. The first person to build a fortune from water rights was T. Boone Pickens. Pickens was a Texas oil billionaire. In the 1990s, he began buying cheap land in the Texas Panhandle. He did not buy it for cattle. He did not buy it for crops. He bought it because that land sat above the Ogallala Aquifer. The Ogallala Aquifer is one of the largest freshwater reserves in the world. Pickens quietly acquired the rights to pump 65 billion gallons of water per year. That is enough water to supply a city of 1 million people. Then he made his move. He sold a portion of these water rights to 11 Texas cities for more than $103 million. He did not sell the land. He sold the right to pump water. This transaction changed everything. It showed Wall Street that water could behave like a financial asset. And Pickens eventually held water rights valued at more than $500 million, all from land nobody cared about until he recognized its hidden value. Wall Street enters the water game. After Pickens proved the model, institutional investors moved in. The most aggressive player is Water Asset Management, also known as WAM. WAM began buying farmland in Colorado. Their goal was not agriculture. Their goal was senior water rights. Today, they control thousands of acres along the Colorado River Basin. The farmland itself may be worth $50 million, but the attached water rights are valued at more than $300 million. Their strategy is simple and effective. First, buy farmland with senior water rights. Second, improve agricultural efficiency so the farm uses less water. Third, sell or lease the unused water rights to cities and developers who desperately need water. This is water arbitrage, and it is completely legal. WAM proved that water rights can become a long-term monopoly asset, and they proved it at institutional scale. The Resnick dynasty, the most powerful water family in America. If Pickens invented the model, the Resnick family perfected it. Stuart and Linda Resnick own the wonderful company. Their products include pistachios, almonds, mandarins, and pomegranate juice. But their real wealth does not come from their crops. It comes from water. In the 1990s, the Resnicks began buying tens of thousands of acres in California's Central Valley. The Central Valley is one of the most water-stressed regions in the country. This means water becomes more important than land. But the Resnicks did something even more strategic. In 1994, California held a series of obscure regulatory meetings. These meetings discussed a new concept called water banking. A water bank is a government-built reservoir. It stores water in wet years. It releases water in dry years. Most people ignored these meetings. Cities were not paying attention. But the Resnicks were there. They recognized an opportunity. New regulations allowed private entities to control access to water stored in government-built banks. The Resnicks moved quickly. They gained control of the Kern Water Bank. The Kern Water Bank is one of the largest water storage facilities in the United States. It can store roughly 500 billion gallons of water. During droughts, the Resnicks sell stored water to other farmers and cities. They sell it at massive markups. They effectively turned public water infrastructure into a private revenue engine. It is one of the most quietly profitable water monopolies in American history. The church that outbid Bill Gates. In 2021, the Church of Jesus Christ of Latter-day Saints made a surprising move. The church bought more than 22,000 acres of farmland in eastern Washington. They spent over $200 million. They outbid Bill Gates's investment firm. Why did a global church buy so much farmland? Not for crops, not for real estate. They bought it for water. Specifically, they bought senior water rights on the Columbia River system. These rights guarantee water access for generations. The church is now one of the largest agricultural landowners in the American West, and their strategy mirrors the billionaires. They're securing water security for the long term. The shadow consolidation. Another player entered the arena in the early 2020s. Crown Columbia Water Resources attempted to file a massive application with Washington State. Their plan was enormous. They wanted to buy private water rights from farmers across the Columbia River watershed. They wanted to store that water in public systems. Then they wanted to lease or sell that water to cities and developers. This would have been the largest private consolidation of water rights in American history. Public backlash stopped the application, but it did not stop the company. Today, they continue to buy water rights quietly through smaller deals. These deals do not trigger public review. This is a clear signal. Water rights are becoming a rapidly consolidating private market, and the public barely notices it happening. The future. Water rights are the new oil. Climate change is shrinking snowpack in the Rocky Mountains. The Colorado River has lost almost 20% of its flow over the last century. The Ogallala Aquifer is being drained faster than it can recharge. Every scientific model shows the same direction. Water scarcity will increase, water demand will increase, and senior water rights will become the most valuable asset of the 21st century. In 2030, the people who control water rights may be wealthier than the people who control oil. Societies can function without gasoline. They cannot survive without water. This brings us to the third asset. It is the strangest asset of them all. It is the most misunderstood, and it is the only asset that pays investors when disasters strike. Water rights give billionaires power over survival. But some billionaires want more than survival. They want profits that rise in chaos. They want assets that perform well when the world performs badly. And that leads to the third asset class. It is the strangest one. It is the most misunderstood. And yet, it is the quiet favorite of pension funds, hedge funds, sovereign wealth funds, and ultra-wealthy investors. This asset is called a catastrophe bond. Most people call them cat bonds. Let us break down exactly what they are and why billionaires are buying them. The basic idea behind a cat bond. A catastrophe bond is created by an insurance company. The insurance company wants protection against a major disaster. For example, a hurricane hitting Florida or an earthquake hitting Japan. Normally, the insurance company would buy reinsurance. Reinsurance is insurance for insurance companies, but reinsurance is expensive, and reinsurance companies have limited capacity. So instead, the insurance company creates a special purpose vehicle. This vehicle issues bonds to investors. Let us use a simple example. The special vehicle issues $500 million of cat bonds. Investors buy those bonds. The money from investors goes into a safe collateral account. This account usually holds U.S. Treasury bonds. The insurance company pays investors a high interest rate. The interest rate is usually 5% to 10% above Treasury yields. If nothing bad happens, investors earn very high returns. If a disaster does happen, investors lose their money. That is the core idea. You either earn a high yield or you lose everything. It sounds extreme, but the returns attract billions of dollars because cat bond risk is completely uncorrelated with the stock market. A recession does not cause a hurricane. A trade war does not cause an earthquake. A stock crash does not create a wildfire. This is why cat bonds offer something rare. They offer true diversification. The performance that beats traditional markets. Let us look at the numbers. In 2024, catastrophe bonds returned 17.4%. That is more than double the S&P 500. It is more than triple the return of investment-grade bonds. In 2023, cat bonds returned 19.8%. Again, they outperformed nearly every traditional asset class. In the 2025 market meltdown, the S&P 500 fell 15%, real estate fell, gold fell briefly, but cat bonds went up 1%. They rose while everything else crashed. Why? Because financial crises do not cause physical disasters. Cat bonds are tied to natural events, not economic events. This makes them one of the purest forms of diversification in the world. Billionaires love assets that do not care about recessions, politics, inflation, or interest rates. Cat bonds ignore all of that. They only care about weather and nature. A famous example of risk and reward. To understand cat bonds, we need one real example. In 2011, a cat bond called Mariah Ray was issued by American Family Mutual Insurance Company. It covered severe thunderstorms and tornadoes. Investors earned 6.25% interest per year. The bond would trigger only if tornado losses exceeded $825 million. Historically, that level of tornado damage happened once every 10 to 15 years. Investors believed the odds were good. Then 2011 arrived. It became the deadliest tornado season in modern U.S. history. There were 983 tornadoes. Losses exceeded the trigger. Investors lost all $100 million of principal. But here is the surprising part. Even with that massive loss included, a diversified portfolio of cat bonds still earned about 11% average returns per year from 2010 to 2020. Cat bonds work like casino odds flipped in the investor's favor. You lose big once in a while, but you win small, steady, and consistently over the long term. Why the market is exploding in 2025 is. The cat bond market is growing faster today than at any point in its history. Outstanding cat bonds now exceed $50 billion. 5 years ago, the number was $33 billion. Insurance companies issued $23 billion of new cat bonds from 2024 to 2025. That is the largest issuance year ever recorded. Why is this happening? There are 3 reasons. First, climate change is increasing disaster frequency and severity. Insurance companies cannot handle the growing number of claims. They need outside capital. Second, insurance premiums are rising. When premiums rise, cat bond yields rise. Higher yields attract more investors. Third, investors now understand that cat bonds offer genuine diversification. In 2022, both stocks and bonds fell at the same time. Traditional diversification failed. Cat bonds did not fail. They went up 5%. Investors noticed. The new players entering the market. Cat bonds used to be dominated by reinsurance companies, but in 2025, the market is evolving. Primary insurance companies now issue more than half of all cat bonds. Companies like Allstate, State Farm, and Farmers Insurance are bypassing reinsurance. They are going directly to investors. This makes the market deeper. It makes it more liquid. It makes it more stable. Institutional money is also flowing into the space. Dedicated insurance-linked securities funds allocate billions to cat bonds. Pension funds allocate billions. Sovereign wealth funds allocate billions. Even reinsurance companies sometimes buy cat bonds created by other reinsurers. The market has become a core part of global financial infrastructure. It is no longer a niche. It is becoming mainstream. The hidden advantage, mispriced risk. Here's a detail that most retail investors never hear. From 1997 to 2025, cat bonds delivered an average return that exceeded expected losses by 4 percentage points per year. This means investors were paid more than the actual risk justified. Why does this happen? Because investors demand a premium for unfamiliar risk, and because the market is still inefficient. Sophisticated investors with strong catastrophe models can find underpriced bonds. They can earn excess returns. This is why billionaires allocate to cat bonds. They see inefficiency, and they move in before the crowd. The new frontier of disaster risk. In the past, 75% of cat bonds covered hurricanes in the United States. But the market is diversifying. Now cat bonds cover earthquakes in Japan. They cover wildfires in California and Australia. They cover floods in Europe. They even cover mortality events from pandemics. Cat bonds are no longer about Florida hurricanes. They are becoming a global disaster risk marketplace. This is the final clue. It explains why billionaires buy farmland, water rights, and catastrophe bonds. The three assets seem unrelated, but they share a single pattern. They are scarce, they are essential, they are inflation resistant, and they survive disasters. In some cases, they profit from disasters. This brings us to the final chapter. Now we can finally connect the dots. Farmland, water rights, catastrophe bonds. On the surface, these three assets look unrelated. One is physical land, one is a legal entitlement, one is a financial instrument built on disaster risk. But to the ultra-wealthy, they are part of the same long-term strategy. They are civilization-level hedges. They are assets that protect wealth when the global system shakes. To understand why billionaires buy these assets, we must break down their shared characteristics. The first trait, scarcity. Farmland with premium soil cannot be created. It was shaped by geology over thousands of years. Once it is degraded, it is gone. Water rights cannot be created either. They were allocated in the 1800s. Almost all senior water rights have already been claimed. Catastrophe risk cannot be created or expanded. It exists because geography and climate exist. This means all three assets are scarce, and scarcity is the ultimate foundation of long-term value. The second trait, essentiality. Humans can live without stocks. They can live without cryptocurrency. They can live without real estate speculation, but they cannot live without food. They cannot live without water. They cannot survive natural disasters without insurance. Farmland feeds populations. Water rights sustain agriculture and cities. Cat bonds stabilize insurance systems during crises. These are not luxury assets. They are essential pillars of human survival. The third trait, inflation resistance. When currencies lose value, farmland becomes more expensive. Food prices rise. Land that produces food rises with them. When water scarcity increases, water rights become more valuable. Cities must pay whatever it costs to secure supply. Cat bonds pay floating rates that adjust with interest rates and inflation. As inflation rises, yields rise. All three assets hold real value even when money does not. The fourth trait, disaster resilience. This trait matters most. Farmland survives recessions. It survived the Great Depression. It survived 2 world wars. It survived the financial crisis of 2008. It survives because food stays essential during every crisis. Water rights are even more resilient. Droughts and disasters make them more valuable. When water becomes scarce, senior rights become gold. Cat bonds are literally designed for disasters. They pay high returns precisely because they are uncorrelated with stock market crashes. When markets fall, cat bonds can hold steady or rise. These are the traits billionaires look for. Assets that survive volatility, assets that survive inflation, assets that survive systemic shocks, assets that survive the failure of currency itself. The real reason billionaires are moving now. Billionaires do not buy these assets for quick returns. They buy them because they believe something deeper is happening. They believe the global financial system is entering a period of sustained instability. They believe currencies are weakening. They believe climate pressures will reshape supply chains. They believe essential resources will become more valuable than speculative assets. They believe traditional diversification no longer works. In 2022, stocks and bonds fell at the same time. The classic 60-40 portfolio failed. For the first time in decades, people saw that diversification could break. Billionaires learned from that moment. They sought assets outside the financial system, assets tied to physical reality, assets tied to survival, assets that do not care about recessions, assets that do not care about political cycles, assets that do not care about interest rate decisions. This is why they are accumulating farmland, water rights, and cat bonds in 2025. How non billionaires can get exposure. You probably cannot buy 69,000 acres in Louisiana. You probably cannot outbid Bill Gates in Washington state. You probably cannot negotiate senior water rights from 19th century ranch families. And you probably cannot invest $10 million into a dedicated catastrophe bond fund. But you can still gain exposure. The first option is Farmland REITs. Farmland Partners owns more than 177,000 acres. Gladstone Land Corporation owns more than 100,000 acres. These companies pay dividends and allow small investors to participate. The second option is fractional farmland platforms. Platforms like AcreTrader and Farm Together allow investors to buy pieces of individual farms. Minimums range from $15,000 to $50,000. The third option is water-focused companies. American Water Works owns water rights and distribution systems across multiple states. Xylem creates water filtration and infrastructure technology. The Invesco Water Resources ETF holds a basket of water-related companies. The fourth option is catastrophe bond funds. Stone Ridge manages a fund with exposure to cat bonds and insurance-linked securities. Pioneer offers another fund. Several ETFs track broad cat bond indices. These options do not perfectly replicate billionaire strategies, but they offer a pathway into the same long-term themes. The final message. Let us be clear, this is not financial advice. It is a window into how the ultra-wealthy think about the future. They are not buying these assets because they expect 20% returns next year. They are buying them because they expect instability. They expect volatility. They expect shocks to the global system. They expect currency regimes to shift, and they expect essential resources to become the new foundation of wealth. When Bill Gates becomes the largest farmland owner in America, it is not an accident. When Boone Pickens buys $500 million worth of water rights, it is not random. When pension funds allocate billions to catastrophe bonds, it is not boredom. These are signals. These are patterns. These are warnings. Every reserve currency in history eventually failed. Every empire eventually shifted. The wealthy who saw the shift early always moved into real assets before everyone else. This is that moment. Whether you act or not is your choice. But understanding the pattern is the first step. Because when the world becomes unstable, the person who controls food, water, and risk transfer will be far wealthier than the person who owns dollars in a broken system. History does not repeat, but it does rhyme. And right now, the rhyme is getting louder.